Okay, now let's get started. Last week we talked about what is corporate finance and what are the functions of corporate finance. And the essence of last class was to discuss what kind of functions corporate finance plays. And there are three essential functions of corporate finance: investment decision, financing decision, and liquidity management decision. Investment in assets and how to finance these investments, and for the inevitable mismatch in timing between investment and financing, you need to manage the liquidity position of the company, so-called liquidity management. So investment, financing, and liquidity management. These three are the key functions of financial management. And I want you to keep that in mind. Don't forget. Investment, financing, and liquidity management. When I ask you, you immediately answer investment, financing, and liquidity management. Memorize it. Investment, financing, and liquidity management. And investment, financing, and liquidity management can be seen from the point of view of cash flows or cash. Cash is at the center of corporate finance. Well, there are many different ways to look at corporate finance, but one way that I use, and I use for the purpose of this class, is to look at it from cash flow point of view, from the perspective of cash flows, how the cash flows move within the company. Okay? So cash is at the center of our discussion. Cash is not at the center of your life, but cash is at the center of corporate finance. I want you to remember that. And let me write down, before I go into this slides, today I'm going to write a few charts on the board, and you can get better feel for how cash is moving within a company. So I'm going to use three different parts of this board, and right at the center I start with cash. Can you see this in the back? Okay. Cash is at the center. Suppose you have a rich uncle. I don't, but suppose you do. Suppose you do. You have a rich uncle. Your name was Ko-Hae-ryun. Ko-Hae-ryun has a rich uncle. Hae-ryun is very rich. Okay, she has a rich uncle, and rich uncle gave her some seed money, cash, and he also gave her, allowed her to use a piece of land, and building, and plant, and equipment for computer part business. Essentially, she is hired executive, CEO of a computer part company. Hae-ryun, the CEO, okay? Are you glad? Okay, here it is. Here's property, land and building, and plant, and equipment. Property, plant, and equipment. And as acronym, PPNE. And this category is called assets, fixed assets, because once bought and installed, it's fixed. Okay, they are fixed. They don't change. Their shape doesn't change. Okay. Cash and property, plant, and equipment are given to her to manage, and cash and property, plant, and equipment, the value of the cash and value of property, plant, and equipment is called capital. So she's given capital. Okay? She's given capital to buy property, plant, and equipment, or to have property, plant, and equipment, and cash. And she was given also human resources. This is on a separate part, human resources. And she is also given technologies. So a lot of things are given. Okay? Given human resources and technologies, and given your capital, you are ready to start up your business. Start your business. Okay? What would you do as a manager of this company? You are going to make computer parts and sell and make money, right? That's the idea. Do you get it? That's the idea. What do you do in practice? You sit down in your manager's chair and that's all? You have to do something, right? What do you do? Your name? 김성찬? 김성찬. What did you do? Okay, you were given human resources. You were given already people who will work for you. What did you do? See, this is a company. The company needs to go on, right? In order to make it go on, what do you do? Check the finance. But check the finance, yes, that's of course important. But finance for what? Experiment. Well, they're all done. The experiment has been already done. Make customers to whom you sell, right? You want to sell. You have to sell, right? Sell what? Computer parts. You have to make computer parts. In order to make computer parts, what do you need? Huh? Money. Yes, you're given cash. You have money. Huh? You have ideas. Huh? Resources. I think you mean what I think I intend. Okay, that's raw materials. Raw materials. You have to buy raw materials. So let me put raw materials over here. Raw materials. I'm going to write about 5 different lines from up there. Raw materials. And when you have raw materials, and you have human resources, and you have equipment, you begin processing, you begin production, right? And raw materials will change shape into work in progress. And work in progress, when process is done, you have finished goods. You with me? You have computer parts to be shipped out of the plant. And these 3 are put together in one category and called inventory. Raw materials inventory, work in progress inventory, and finished goods inventory. So you have inventory. That's inventory. And finished goods, they are in the front yard and in your warehouse. And that's not the end of the process. What do? You have to sell. You sell. You find your customer and sell. When you sell, what do you get? Yeah, you get money. Oh, nice money. You get this nice money. But you don't get this nice money in real business. They usually get the promise for the payment. It's called accounts receivable. Accounts receivable. They are the finished goods are sold to the user, the buyer, and the buyer will promise you to pay back the amount in certain time period. Okay? It's called accounts receivable. And accounts receivable will finally be collected, and it will become cash. So notice that cash is used to buy raw materials, and raw materials become work in progress, and work in progress becomes finished goods, and finished goods will become accounts receivable, and it is collected to become cash. This is how cash moves within a firm. That's why it's called, this cycle is called cash cycle. So I'm looking at the company's operation from cash point of view, cash flow point of view, how cash flows within a firm. Cash becomes raw material, and this process is called procurement. Procurement. You procure raw materials. And from raw materials, finished goods, it's called production or manufacturing. Correct? And from finished goods to accounts receivable, that's sales and marketing. And after that, you collection. So you see, management functions are all there. Procurement, production, sales and marketing, and collection. That's management. You are looking at the entire management process from cash flow point of view. Of course, there are other management categories, such as human resources management, the technology management, or R&D management. There are other managements as well, but the essential thing is production and marketing, and in order to do that, procurement and collection. This cash cycle, and the items in the cash cycle is added up, and they become current assets, because current assets, the lifespan of asset category is not longer than 1 year, probably short, fairly short. Current assets, and current assets plus property, plant, and equipment, so-called fixed assets, you have total assets. And that's the left-hand side of the balance sheet. Are you with me? So balance sheet, left-hand side of the balance sheets are the assets. And the company invests in these assets. Investment in fixed assets, investments in current assets, investment in inventory, investment in account receivable, and in a sense, investment in cash. Okay? Now, these are investments, and investments need to be financed. You began with capital given by your rich uncle, but you need more money. You need more money. When you run this cash cycle, you need money to make it going. Your original money may not be enough, so you need additional money. And one easy and quick source of financing is so-called trade credit. Trade credit. That's, you purchase raw materials on credit, 외상. You purchase it with the promise that you will pay back the amount, the purchase amount, in, say, 30 days or 60 days, so-called accounts payable. So accounts payable can be used to finance part of the current assets, inventory and accounts receivable. And if you still need more money, then you can go to your friends, well, your parents first, and your relatives, and your friends, and then friendly banks, and sometimes unfriendly banks. By writing a note that you are borrowing money from them, they are called notes payable. And they are current accounts payable and notes payable are primarily short term. The maturity is really longer than 90 days. And other current liabilities, they will comprise what we call current liabilities. And current liabilities, our primary function of that is to finance current assets. Okay? Is it clear? You are looking at, you are learning now accounting, but from user's point of view, user perspective, I'm giving you accounting knowledge from user's point of view. Okay? Sometimes current liabilities are not enough. You need to increase your operation, expand your size. You need more money. And you can go to a financial institution such as banks and ask them to lend you money, so-called long-term debts. And if you add current liabilities and long-term debts together, there will be total liabilities. Once you run this operation, you make profits. Okay? You're supposed to make profits. Unless you make profits, you will not be able to survive. So you make profits. And once you make profits, then part of the profits will be distributed as dividends, and the rest of it will be reinvested within the firm, and reinvested earnings are called retained earnings. And retained earnings are part of the capital. Capital is being replenished or increased by retained earnings. And capital retained earnings included are called stockholders or owners' equity. Or in short, just equity. And total liabilities, stockholders' equity, put together, you have total capital, or we call total liabilities and shareholders' equity. I can't see. I'm sorry. I will. Next time I will write it. Okay, but bottom here, capital, including retained earnings, are called stockholders' equity. Okay, you can read it up to this point. Retained earnings, retained earnings. You don't have to write it down because very similar picture will be appearing on the screen. But for now, this is the right-hand side of the balance sheet, and this is the left-hand side of the balance sheet. Notice that the right-hand side of the balance sheet is showing the company's financing activity, and the left-hand side of the balance sheet shows company's investment activities. Do you see that? The left-hand side and the right-hand side. This side is investments and this side is financing. And more specific scorecard of the company's investment activity and financing activity is written in the income statement. I'll make sure that I'll write above this level, okay? So that you can see. Income statement, the top line is called net sales. This is the amount of sales you're making by selling computer parts. And in order to make sales, you will have to go through this production process and selling process. And production process, usually incurs cost. Cost of raw materials, cost of labor, cost of fixed asset usage, and these are all included in costs of goods sold. And the difference between net sales and cost of goods sold is called gross profit. And you subtract overhead. Most of the costs of goods sold are direct costs or variable costs. They change as sales level changes. But there are other expenses that do not necessarily change with net sales. For example, administrative salaries. They don't change much. Maintaining a headquarter building, that's not necessarily highly correlated with net sales. So overhead, we call that general and selling expenses. You call that overhead. If you subtract overhead from gross profit, you have net just operating profit. Add or subtract other income or expenses. If they are expenses, subtract. Income, add. To find earnings before interest and taxes. More commonly known as earnings, EBIT, EBIT, EBIT. Since this is before interest, let's subtract interest expense. Such as interest on notes payable, interest on long-term debts. Okay? Interest expense is deducted from earnings before interest and taxes, and that will give earnings before taxes. And of course, you subtract taxes to find earnings after tax. After tax, or net profit after tax, or using the acronym NPAT. NPAT. This is the bottom line of an income statement. Bottom line. Bottom line means profit and loss, the company. If the bottom line is positive, the company is making money. If the bottom line is negative, the company is losing money. If the bottom line is negative for several years continually, then the company is in big trouble. Okay? So bottom line, that's the bottom line. Profitability, bottom line. And this one is net of something called depreciation expense. Depreciation means the use of fixed assets like property, plant, and equipment. You use the building, use the plant, use the machine, use the equipment. And as the more you use, the more value will be subtracted from the value of the assets. Value of the assets will decrease because of the usage of the assets. So you subtract depreciation. Depreciation is natural expense of the company's ownership of assets. But depreciation doesn't involve cash outflows. There's no cash involved in depreciation. Depreciation is included in cost of goods sold and overhead, and this depreciation is added back to find cash flows to the stockholders. Subtract net new just investments. Investments, I mean new investments, and that will give you free cash flows. In acronym FCF to stockholders. So the complicated part is over. Okay. Now we start with cash. And we saw how cash is moving around within the firm to create profits. And amount of profits that are generated from the company's operation is summarized in the income statement. Income statement shows you how much money the company makes, and part of the net profit that was made by the company will be reinvested within the firm to increase the capital size of the balance sheet. So balance sheet, income statement are closely related, linked to show how the company is doing within a given year. Okay? Are you with me? Right? That's the whole thing about financial management. And that's the whole thing about accounting. I summarized the whole accounting. Accounting, I think that you are taking this semester. You are learning accounting. You learn the details, important concepts of accounting from that course. But from user's point of view, that's all you need to know about accounting. Okay? If you don't feel comfortable with it, go and check your book. Your book has essentially the same discussion. And yeah, you can ask me questions.
You are adding back the
Depreciation is an expense, but that does not involve cash flows. Yeah. This is the profit. Okay, I have profits, but that's not necessarily cash flow to the shareholders. I would like to see the cash flow to the shareholders. So I add back non-cash expenses and subtract investments in order to have the cash flow that is freely distributable to the stockholders. Other questions? Okay. If you don't feel comfortable with it, just stay, just keep trying, okay? You don't have to have 100% understanding of it, okay? Now, let's move on with the discussion. Oh. Okay, today's lecture, only 15 minutes left as far as my lecture goes, 15, 20 minutes left. I'll talk about balance sheet here, income statement, and taxes, and cash flows. I already told you the important concepts. Now I will fill the holes. The balance sheet is a snapshot of the company's assets and liabilities at a given point in time, right? Assets are listed in order of decreasing liquidity. Cash through raw materials, they have reasonable level of liquidity. In other words, they can be converted into cash rather easily without much loss of the value. Balance sheet identity means the left-hand side and the right-hand side should balance. Assets must be equal to liabilities plus stockholders' equity. If they don't balance, then you fire your accountant. Or if you are account yourself, then you should study again. Okay, here is your book's example of a balance sheet of the company called Asia Pacific Corporation. Look at total assets. It moved from $2.756 billion to $3.112 billion. The right-hand side equal to the left-hand side. Cash position was 104, now it's 160. Property, plant, and equipment, that's 1.6 billion to 1.7 billion. Look at the accounts payable. It's about $34,000 more in account payable, but notes payable, substantially less. Something has occurred in the company's current liability structure. Okay? The job of a financial analyst is to find out what happened in the current liabilities, accounts receivable and notes payable. What happened? And good financial analyst will come up with an answer. I don't know what it is, and you figure out. Long-term debt has increased to 454. Now look at this. Current liabilities has decreased by about 40,000, and long-term debt has increased by about 40,000. So in a sense, the company has replaced current liabilities with the long-term liabilities, long-term debt. By borrowing long, they pay off short-term. That may be what's explaining the structure of the liability side. Look at this. Retained earnings has gone up by 300 and something, 309. 309 is the increase in retained earnings. Where does that come from? Increase in retained earnings. From your understanding of this balance sheet, where does it come from? Retained earnings. Increase in retained earnings of 309. Where does it come from? Well, you don't know yet, but it will become clearer in about 3 minutes, okay? Wait for 3 minutes. Now let's move on to the next slide. This slide is essential representation of the same stuff. Current assets on the left-hand side and fixed assets, again, on the right-hand side, left-hand side. And this has higher level of liquidity and low level of liquidity. And right-hand side, current liabilities, due date coming up within 1 year, and long-term debt for longer term, and shareholders' equity. And here's a new concept called net working capital. Net working capital is a concept that you need to understand. I said current liabilities are used as the financing of current assets. Current liabilities are used to finance current assets. The difference between current assets and current liabilities are called net working capital. net working capital. And the term net working capital, each of the words has its own meaning. It's net. It's a net working capital because net of current liabilities. Current assets, net current liabilities. That's why it's called net. It's a working capital. It's working because it is working. This thing is working all the time. The company, even though it is not, you cannot see it, the company is always doing this thing. Purchasing raw materials, processing it, and sell, and collect, and again purchase, produce, and sell, and collect. This process keeps going on. That's working. So net working. And it's capital. That's money to be used for the operation of the firm. So net working capital. Each of the three words has its own meaning. Net. It's net of current liabilities. Working. It's constantly working. And capital. It's used for company's operations. Are you with me? Okay. Move on to the next slide. Here's a definition of net working capital. Positive when cash that will be received over the next 12 months exceeds the cash that will be paid out. Usually positive in a healthy firm. Liquidity. Ability to convert to cash quickly without a significant loss in value. Liquid firms are less likely to experience financial distress, but liquid assets typically earn a lower return. Trade-off to find balance between liquid and illiquid assets. Okay, move on. Market value versus book value. The balance sheet provides the book value of the assets, liabilities, and equity. Balance sheet is recorded. And its accounting principle is to record everything, all the assets, in historical cost. I know one firm which was founded almost 100 years ago in New York City, Midtown Manhattan, right at the center. And it purchased it built a headquarter building. It's high-rise. And headquarter building, the cost of building that, the historical cost of that building is probably less than $100,000. Okay. Nowadays, it's $100 million, several $100 million. It's market value of it is several $100 million, and it used to be $100,000. The company's balance sheet shows historical cost of that building. That's not the same as market value. Market value is substantially higher. The market value is the price at which the assets, liabilities, or equity can actually be bought or sold. Market value and book value are often very much different, especially for old firms. So you have firms in your group. Some firms are old, some firms are young, and for old firms, you may see a substantial discrepancy between market value and book value. Which is more important to the decision-making process? Well, of course, market value. So finance people, they look at the balance sheet in terms of market value balance sheet. And here, the left-hand side has net working capital, current asset, net of current liabilities, and net fixed assets. And the liability side, long-term debt and shareholders' equity. And you can see, obviously, that net fixed assets, market value is $300 higher, and working capital is also $200 higher, and they are all reflected in the shareholders' equity. Okay, income statement. The income statement is more likely a video of the firm's operations for a specified period of time. You generally report revenues first and then deduct any expenses for the period, as you saw already. Matching principle, GAAP, generally accepted accounting principle, says to show revenue when it accrues and match the expenses required to generate that revenue, so-called matching principle. And here's Asia Pacific Corporation's income statement. And the only thing I would like to emphasize is the bottom line. 412 is the profit, net profit after tax. Okay, and 103 are paid out as dividends, and the remainder reinvested within the firm, and the amount is 309. Where did you see the number? Where did you see the number? You already saw the number, 309. Where did you see? Balance sheet, right-hand side, bottom of the right-hand side. You see retained earnings has gone up by 309, and that's this number. This number is added to the company's capital. Taxes. Taxes. In this world, nothing can be said to be certain except death and taxes. That's said by famous U.S. statesman Benjamin Franklin in 1817. 1817, 200 years ago, he said, death and taxes are the only two things that are certain in our life. Okay? Nothing is uncertain, but the only thing that is certain is death. We all die. When we die is uncertain, but we all die. That's for sure. Okay? There's nobody who can live forever. I don't think anybody wants to live forever. Okay? Taxes. It's inevitable. And taxes are always very tricky and sensitive. The current Korean administration, Park Geun-hye administration, is having a hard time with these taxes. It has to have enough revenue, tax revenue, to have good welfare spending, but the sources of tax is rather limited, and wants to increase taxes, but increasing tax is a death sentence for the administration, for the politicians. If you increase tax, you will lose the election next time. So it's a delicate dilemma for politicians. But anyway, death and taxes are two certain things in life. Margaret Mitchell is the author of famous novel, Gone with the Wind. And in that novel, you see Scarlett O'Hara, the main character, said, death, taxes, and childbirth. There's never any convenient time for any of them. That's true. Okay? But there's one thing that is fairly certain. That is, the one thing that we can rely on with taxes is that they are always changing. Tax laws are changing, tax rates are changing, tax schemes are changing. One important thing you have to learn, I'm not going to teach you how to do it, but you will have to read and figure out yourself marginal tax rate and average tax rate. Marginal tax rate is the tax rate applied to the marginal dollar, the last dollar you are earning. That's marginal tax rate. Average tax rate is average tax amount divided by average income. Corporate tax around the world, look at US, 35%. That's statutory rate. Korea is 24.2%, including resident tax. Effective rate, that's the after accounting for subsidies and tax favors and all that. US, it's almost 40%. Korea, it's only 16.8%. And that's why a lot of politicians are arguing that Korea should increase corporate tax rate. But corporations, they come and say that if we increase corporate tax rates, a lot of corporations will move outside of Korea. They will leave Korea to other countries that have lower tax rates, such as Hong Kong, Singapore, and others. You figure that out yourself. Cash flow. I'll spend about 5 minutes to talk about cash flows. Cash flow is one of the most important pieces of information that a financial manager can derive from financial statements. This is not the same as statement of cash flows that we'll be discussing on Wednesday. But the concept that we would like to emphasize is cash flow from assets, CFFA, cash flow from assets. These are the assets. And how much cash flows are generated within a given year? That's what we are interested in finding. That's CFFA, cash flow from assets. How much of cash flows are generated from this investment activities or assets? Okay. There are two ways to find that out. One is to look at the income statement or to look at the right-hand side. Because the cash flows from assets will be eventually distributed to the suppliers of capital, debt holders and stockholders. And cash flow from assets are coming from the firm's operations. So you can look at the left-hand side, the income statement side, or the right-hand side of the balance sheet to find the cash flow from assets. The lower one, cash flow from assets, is operating cash flows. Operating profit plus depreciation, okay, minus net capital spending, that's investments in fixed assets and investment in net working capital. That will give cash flow from assets from the income statement. The cash flow from assets will be distributed, will be going to the debt holders, liability holders, and stockholders. So cash flows to creditors, liability holders, and cash flow to stockholders. If you add them two, you have cash flow from assets. And the rest of the pages are examples, actual examples. Go through these examples one by one. Asia Pacific Corporation, you have the balance sheet and income statement information. You can compute operating cash flow, net capital spending, and change in net working capital, and you can find cash flow from assets. Or you can find cash flow to creditors and cash flow to stockholders, and you can compute the same. And the answer is always, always same. So this is the summary of cash flows, and this is an example that you might want to do it yourself. Concept review, we've already discussed it, so never mind. Now that's all for today's lecture. There are few other things that I would like to assign today. Number one, this is already you know. By Wednesday, you have to submit your segment 1 of your project. Again, this project is individual project. Individual project, you will upload it to your assignment section, okay, of eClass. And if you want my feedback, you can give me a hard copy in addition to uploading your report. Uploading of your report is your must. Okay. Okay. I'm not done yet. I'm not done yet. You have to give me about 3-4 more minutes. Exercises. Do problems in 14, 19, 21, and mini case in your book. And I have uploaded answers to those problems and case studies. So you check your answers with the answers I gave to you on the general materials section. Here's something else, one other assignment, so-called. On Wednesday, I'm going to talk about cash flows, and then I'm going to talk about financial analysis. You are getting really deeply into financial management. And on Wednesday and next Wednesday, two Wednesdays, we'll talk about financial analysis. Okay? This is one example that I would like to handle. Okay? It's a company called Green Paint. I created this artificial company, hypothetical company. You see assets and liabilities and capital for 5 years. Okay? Listen to me carefully. This page, as well as next two pages, are in your class note 3. Okay? Class note 3 has this. Using this balance sheet and using the income statement, somehow I made a mistake of knocking off one line. It's called net sales. The most important information is not shown here. I will check and make sure that it's been properly revised before today is over. Okay. Using income statement and the balance sheet, I want you to compute. Well, it is already computed for your benefit. Okay? There are 14 ratios that I would like to use throughout the semester. Okay? These 14 are the essential ratios that you should be very familiar with, right? And formulas are all given, and the answers for year 2010 is also given. And another given thing is industry average. You might want to compare the company's ratios with industry average to see how your company is doing. So I want you to do the following. Your group, get together, spend about an hour, maybe half an hour to 1 hour, study together, and look at each and every ratio and evaluate how good that ratio is compared to the industry average. Current ratio of 1.42 versus industry average 2.1. Is it good? Is it fair? Or is it terrible? Or is it really, really catastrophic? Okay? So I want you to give a grade of A if you think it's a good ratio. Okay? If it's fair, not too good, but not bad. Okay, B. If it is bad, C. And if it is truly bad, and this is really problematic, then give a grade of F. Okay? These are the grades that I will be giving to you at the end of the semester. So I want you to have the feel for grading. Okay? Grade each and every one of those, and then at the last moment, grade the entire company. How good is this company? Is it a good company or bad company? Okay? This will give you flavor of financial analysis. Once you're done with this exercise, you will become familiar with the concept of financial analysis. What to do with financial analysis. Okay? I think you can be proud of yourself once you complete this exercise. Okay, that's all for today's class. If you have any questions, now it's the time.